Okay, we're going to go ahead and get started. A couple of your classmates have sports obligations today, so they're not going to be here. So I told them that I would record the class for them. So for that reason, we're going to do most of what I talk about. I'll instead of writing on the board, I'll write up in this Excel spreadsheet, just because I'm screen capturing my computer right now so I can post that later. So if there's anything that you didn't understand or you want to hear over again, I'm going to post this up on Blackboard later today. So also, if you ask a question and I repeat it back, the microphone's right here, and I don't know how much it's going to pick up, so I'm not just hard of hearing. Okay, so today we're going to talk about also, usually I like to pace around and stuff, so if I look uncomfortable just kind of standing behind here, it's because I can't walk around because I'm trying to talk into the computer. What we're going to talk about today is all information that you will see in the book as we go forward, okay? So nothing we talk about today is going to be only discussed today. We're going to talk about some of the major, I guess, concepts that people have the most trouble with in accounting. Okay, so you know, I'm taking a full class today to talk about these things, and like I said, they will be broken up and discussed as we move through the material in the book. I follow along exactly with how the book teaches. So if you've had classes before where they say, "Hey, go buy the book, go read the book," and then you don't ever talk about anything in the book, that's not how it's going to be in this class. We will cover exactly what the book covers. The quizzes and tests will be over exactly what's in the book. So I try to kind of hit it from a different angle in class, and then you can read it in your book and get it from a different angle there, and then hopefully understand the material a little bit better. Okay, so with that in mind, I'm going to put some stuff on here, and if you're a person that likes to take notes, you don't have to necessarily worry about taking notes on everything that we talk about today. Okay, there's basically 4 main themes I want you to take away from class today. And everything else, you know, I might go a little bit further in depth into something, and it's not because I want you to learn all of that right now. It's because, you know, I'm just, you know, going into more depth to explain something. But I will tell you exactly what the 4 takeaways from today's class should be. So if I say, hey, this is one of those 4 things, then that's what you should write down. Okay, so the first thing that I want to talk about, I'll write it up here. This is one of the 4 things that I'm talking about that's important. Okay. It is called the basic accounting equation. Is that big enough that everyone in the back can see that? Back row, yes? Okay. So, basic accounting equation. I think I mentioned before that you don't have to be a math genius to understand accounting, right? So, with that being said, I don't know if you guys heard it before, but I do want computers to be away in the class. Okay. Okay, basic accounting equation is assets equals liabilities minus owner's equity. Okay, that is the basic accounting equation. Pretty simple, right? You have assets on one side, and you have liabilities minus owner's equity on the other side. I assume everybody in this class has at some point in their life taken an algebra class, right? Had to have that to get into school, I hope. Okay. So if you were in an algebra class and you saw an equation like that, you should be comfortable with the idea that I could manipulate and change around that equation and still have it mean the same thing, right? So if I wanted to get owner's equity from the right side of the equal sign to the left side, I could add owner's equity to both sides of the equation. Is that ringing any math bells in y'all's head? Okay, so pretty simple math concepts. That's probably the most vague type of math concept we'll deal with in accounting. It's just being able to manipulate an equation and know that it is the same thing, right? So one of the key concepts that you need to understand in accounting is for this equation, any transaction that happens this equation is always going to be balanced. Okay? So whatever I do to one side of the equal sign, I will have to do the same thing to the other side of the equal sign. So, like, for instance, moving owner's equity, I add owner's equity to both sides of the equal sign. That way, it's still equal to each other. Anybody ever heard of the term or the document called a balance sheet? That's even if you don't know exactly what it is, I assume most of you have heard the term balance sheet before, and that's because that's one of the main financial statements that is talked about with any type of company. Did anybody in here ever invested in any stocks or looked at any stocks or anything like that? Okay, that's one of the things that potential investors would look at. They'll usually look at how a company is performing, and one of the ways they find that out is by looking at the balance sheet. Well, what the balance sheet shows you is basically a more blown up view of this equation. Okay? It's called a balance sheet because it's basically an equality. A balance sheet will show you first assets and then list out the various asset accounts that a company has, and then it will total those out. So you'll see a total there. Then it will list out liabilities and owner's equity. Whoops. Caught a mistake here on my own part here. This is actually plus owner's equity. Liabilities plus owner's equity. Sorry, I'm human as well. And I have a cold, so I'm high on cold medicine too. So if I say something that's totally out there, you'll understand why. Okay, so liabilities plus owner's equity. So the balance sheet has assets and then a total, and then it has liabilities and a total, owner's equity and I guess a subtotal, and then it will total out liabilities plus owner's equity. And obviously for this equation to stay true, the liabilities plus owner's equity section will be the exact same number as the assets section. Okay, that's why they call it a balance sheet, because they balance with each other. Okay, so in my mind, I imagine, have you all seen like the scales of justice, where you have a scale that's like a balance, and you put something on one side and you put something on the other, and they balance? Everybody know what I'm talking about with that? Okay, so I kind of imagine one of those in my head when I'm talking about this basic accounting equation. So every transaction that happens in a business can be plugged into this basic accounting equation. So somebody tell me the name of a business. Any business. Let's make it a famous one that most people will know. Walmart. Okay. So Walmart has many, many, many transactions, right? Think of a business transaction that relates to Walmart. Someone tell me something that happens in the course of Walmart's business dealings. Any ideas? What does Walmart do? Sell stuff, right? So let's say, for the sake of arguing, now Walmart's a little bit unique because a lot of the stuff that they sell is stuff that they've produced themselves. But let's say, some of the food and some of the other stuff that they sell is just stuff that they've purchased from a wholesaler, and they're now selling it at cheap retail, right? So let's say Walmart purchases $10,000 worth of televisions, okay? So that's a business transaction. So that's going to affect both sides of this basic accounting equation. So can someone tell me what an asset is? Any idea what an asset is? Okay, something you own. That's a decent attempt at it. Any other ideas? Something of value. That's a better definition, because if you look in your book, what the definition that you usually find in an accounting book is something that you can basically turn into cash, okay, at some point in the future. And that does translate to something that you own, right? But I would say a more correct definition would be something that you own of value, okay, that you can change into cash. So obviously cash itself doesn't need any changing to be changed into cash. That's an asset. But you have other assets too, like if you're Walmart, all of your inventory is an asset because obviously you plan on selling it for cash. Land is an asset, a building is an asset. If you're a drug dealer, your drug supply is an asset. anything that you have that can be turned into money is an asset, right? So in this case, what asset is Walmart going to be using to purchase televisions? Money, right? It could be cash. They're probably not going to get a briefcase full of cash and bring it to the buy, right? But we'll call it cash, even if it's just like a bank wire or bank transfer. So we have minus $10,000 cash. Whoops. I don't care. Okay. So that's on the left side of this equation, right? Because that is an asset, and that's going down. Okay. So for this, and this is a bit of a tricky one because I'm actually not going to do something to both sides of this equation, but I still have to make this equation balance. Okay. So let's say, just for the sake of argument, I'm going to plug some numbers in here. Let's say, and obviously this is not true for Walmart, but let's say $100,000 is my assets, so that's the first part of that equation. Let's say $50,000 is my liabilities, and $50,000 is my owner's equity. Okay, so this right here is a numerical representation of this equation here. Okay, and what I've just done is I've taken minus 10,000 from the left side of this equation. Right? So now I have 90,000 equals does that balance? No, right? I just took 10,000 away. So there's now two ways I can make this balance. I can either add 10,000 back to that same side, or I can take 10,000 away from the other side. Now you're saying, okay, if this is a math equation, why would I take 10,000 from one side just to add it back to that same side? Okay, and that's a valid point. But in this scenario, it makes sense to do that because there's more than one type of asset account, right? So obviously it would be stupid if I took $10,000 cash away from the asset side and then replaced it with $10,000 cash, right? That would just be a stupid transaction, meaningless, right? No one would take 10,000 out of the bank just to deposit 10,000 in the same transaction. Okay, but what I'm doing instead is I'm taking $10,000 cash, which is one type of asset, and I'm changing that into a different type of asset, which is televisions or inventory. Okay, so now I take $10,000 cash away from the company, but I add back to that $10,000 of televisions. Okay. So now, if I add that back to the asset side, I balance again. Whoops. Okay, so every transaction that I do, it doesn't necessarily mean that every transaction will leave me with 100,000 on both sides, but every transaction should leave me with the same number on both sides of that equation. Okay, so, and I won't write all these out, but thinking of another example here, Walmart, obviously, it has many stores, and they have to pay their people, right? Most people would prefer to be paid in cash rather than, say, with, like, I don't know, hot dog buns. So if I'm going to pay, let's say, $10,000 worth of salaries to employees this week, then my cash, which is an asset, would go down $10,000, okay? And so at that point, I would need this other side of the equation to also go down by $10,000, okay? And without getting too far into why this $10,000 will be coming out of this area, what's basically going to happen here is I'm going to have, whoops, maybe. I'm going to have minus 10,000 cash here, and then I'm going to have minus 10,000 from owner's equity here, And I'm not even going to tell you what the name of that account is because that gets us further deep into this conversation that I don't necessarily want to start yet. But just know that when $10,000 cash leaves the company's hands, this equation is still balanced because I'm taking $10,000 out of owner's equity. Okay, what is owner's equity? Anybody know what that group of accounts is? Let's start with the easier one. What's a liability? Anybody know what a liability is? Just your, what's that? Insurance? Insurance isn't really a liability. Insurance is kind of a complicated account. Just the you might sometimes have liabilities that come from insurance, but I won't get into that. What was some of the other? Okay, by responsible, what do you mean? I'm not saying you're wrong. I think you're going the right way with this, but let's say, well, the easiest way to think about it is, yes.
Be like cost versus profit?
No, liabilities.
You have to pay for whereas equity is profit that you're making back to the company.
Equity is kind of like that, but liabilities, it's a much more simple term, yes. Okay, I like that term, what you're accountable for, but I would go even more specific and say this is something that you are going to owe. Okay, so liability, if we talk about assets as being something that you could turn into cash, okay, liabilities is something that's going to cost you cash or cost you assets sometime in the future. So if I said, for instance, how many people are taking student loans out? Okay, liability. Okay, unfortunately, one that I know very well as well. So this means at some future point, we will have to pay back whoever we're borrowing this money from. So we've incurred a liability. In obviously, even the most successful businesses have liabilities. Okay, it's not necessarily a bad thing. It becomes a bad thing when it's way out of whack compared to what your assets are. Okay. But it's important to understand what liabilities are in order to understand what owner's equity is, okay? Because owner's equity is basically, if I had, let's say I own this company, if I get rid of all my assets and turn them into cash, okay, remember assets is something that can be sold for money. I turn all my assets into cash, okay? And I have these liabilities, which is I'm going to owe cash in the future. So I pay all of those off, okay? I pay all my debt off. Whatever's left that can be distributed to the owners, okay, that's owner's equity. So it's basically, if I own the company and I got rid of all assets and liabilities, what's left to put in my pocket? That's owner's equity. Okay, so it makes sense that if you're paying $10,000 cash out to employees, that's $10,000 that you would no longer have in your pocket once you got rid of all your liabilities. Okay, so that's why this $10,000, when it goes out of cash, it also goes out of owner's equity because it goes out of the pot that's left over once you get rid of everything else. Okay, and we'll get into specifically what accounts this would come out of. This would be out of an expense account. We'll talk about all that stuff in more depth later. The idea that I want you to understand here is that no matter what the transaction is, every single business transaction affects this basic accounting equation and always leaves it balanced at the end of the day. Okay? If you understand that much about the basic accounting equation, you're doing good so far. Must remain balanced, and every single business transaction affects that basic accounting equation. So as we practice this in the coming weeks, we will plug in various different business transactions, and we'll see how those affect this basic accounting equation. Okay, and it's called the basic accounting equation because at the end of the day, you can pretty much boil the entire field of accounting into this basic accounting equation. It all fits in to this equation. Now, obviously, you could take years and years of accounting classes, and it gets more and more complex. But that's basically because each of these categories, assets, liabilities, and owner's equity, have many, many, many different accounts that fit within each of those categories, and the interrelationship between those accounts and how you keep track of things is what makes accounting complex. But this is the basic theme that underlies all of the accounting profession. Okay? And the thing that confuses people the most about this is because of the nature of this accounting equation, there's always two sides to every transaction. Okay? I can't just take $10,000 out of the cash account, because if I only had the one side to that transaction, that would only affect one side of the equation. There always has to be a matching side, a balancing side to that transaction. So every business transaction has something going on one side of the equation, and either something equally going on the other side of the equation, or something opposite of that going on the same side of the equation, like we saw up there. So either assets go down and a different asset goes up to balance it out, or assets go down and either owner's equity or liabilities go down. Okay? So an example of liabilities going down, let's say you take a $50,000, or let's say your business takes out a $50,000 loan. Okay? And then now you're finally making money and you want to go pay that loan back. What do you pay the loan back with? Hot dog buns? Probably cash, right? Okay, an asset. So your assets would go down by $50,000 because you're giving that up. You no longer have $50,000 or $50,000 worth of hot dog buns. But now you're keeping track of what your debt is here under liabilities. And if you're paying that all off, that $50,000 goes completely away. Okay, so your liabilities go down as well. So that's an example of assets and liabilities both going down equally. Okay? So when we talk about balance, this is one major balancing theme in accounting. Okay? This is the slightly less complicated balancing issue that you deal with in accounting. And the two other things that we're going to talk about today deal with the other part of balancing. Okay? So, everybody okay with the basic accounting equation? Yeah? Any questions before I move on? Okay. So, oops. I'm going to format these cells real quick to make a point, so give me a second here. Okay, if you had to pick a letter in the English language that chart looks like, what is it? A T, right? So this is what we call a T chart. Okay, you'll see these in accounting quite often. And this is basically every account that a company keeps track of can be kept track of using this T chart. Okay? And this is where the other component of balance comes into play. Okay, terminology. The two words that probably confuse people in accounting more than anything else. Debit and credit. Anybody ever heard those two words before? Everybody have a bank account in here. Okay, when you're dealing with your bank and your bank account, the teller will often say, we've credited your account, we've debited your account. And that's what most people's understanding of debits and credits usually is. The problem is, if that's your only understanding of debits and credits, and you're thinking about everything in terms of what the bank tells you about your bank account, then you would think credit means increase my account and debit means decrease my account. Okay? That is not the definition of debit and credit. The definition of debit and credit is actually, on paper, much simpler than that, but it confuses a lot of people. What debit means is left, and what credit means is right. Okay? And what that's referencing is this T chart over here. Okay? So if we'll say this account is my cash account. If I debit my cash account for $5,000, that means I'm putting $5,000 on the left side of this T chart. Okay? If I then credit my cash account for $3,000, I put $3,000 on the right side of that T chart. Okay? So just hearing the words debit or credit, if that's all the information you have, you don't know if the account is going up or down. Okay? You have to know, does a cash account carry a debit or credit balance? Okay? And whatever type of balance it carries, that will tell you whether a debit increases that account or decreases that account. Okay? That's where things start to get a little confusing, because depending on whether it's an asset account, a liability account, and owner's equity can go both ways, that will tell you whether debits increase the account or decrease the account. That's why for your basic understanding of accounting, what you need to just drill into your head is that debit means left, credit means right. You can worry about whether that's an increase or a decrease in the account later. But if you always remember that debit means left and credit means right, you'll always at least be putting it on the right side of the T chart when you're figuring it out. Okay? And then for me to understand how much cash I have in my account, you'll see that both of those numbers, 5,000 and 3,000, are positive. So depending on whether the cash account carries a debit balance or a credit balance, I have to know that to know whether I'm $2,000 in the hole in my cash account, or I owe $2,000, or whether I have $2,000 to still spend. Because you can see, if I'm not adding and subtracting to this account, one of these two columns means increases to the account, and one of these two columns means decreases to the account. So anything I write for the cash account on the right side of the T chart is money that's come out of the cash account. And anything I write on the left side is money that's going into the cash account. If I want to know the balance, I just have to figure out what's the difference between these two. Okay? Imagine in your head again that scale of justice. Okay? If you have 5,000 pounds on one side and 3,000 pounds of pressure on the other side, how far down is that scale going to tilt in the one direction? It's going to be down basically 2,000 pounds worth on that one side, because 3,000 on one side cancels out with 3,000 on the other, and you're left with the difference between the two, which is, in this case, $2,000. Okay? So if I gave you a T-chart that had a bunch of this information filled in, numbers here, 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 all you would have to do is total up everything in this column, total up everything in this column, find what the difference is between the two, and write that number on whichever side is bigger. So in this case, I know the difference between 5,000 and 3,000 is $2,000, and since 5,000 is greater than 3,000, I know that the cash account right now has a $2,000 debit balance in it. Okay? I know this is confused. This will probably confuse you throughout the entire first semester. Not all of you. Some people will get it right away. But this concept of instead of pluses and minuses, we have debits and credits. And knowing which side is a plus and which side is a minus really gets confusing. Okay? But for right now, all I want you to take away from today's discussion about this is debit means put it on the left side, credit means put it on the right side. And you should know that to get a total from the account, you just find the difference and total it up on the bottom, and whichever side carries the balance will be the greater side. Okay? Anybody have any questions about that component? Okay. That's what a debit is, what a credit is. Okay, if you ask anyone that's taken just accounting classes, or I'm sorry, just principles of accounting classes, you ask someone 5 years down the road, what do you remember from your accounting class? I guarantee they will at least remember the terms debit and credit, because that goes into every transaction that we do. Okay? So, with that in mind, we got one more topic to cover here. And this is the second component of balance. Okay, remember the first thing we said was, with the basic accounting equation, you got to make sure everything on the left side of the equal sign and everything on the right side of the equal sign are always equal to each other. That's the first component of balance. The second component of balance is every single transaction that you make, okay, every single transaction that you make will have to have an equal number of debits and credits. Okay, this is the abbreviation DR. Don't ask me why it's a DR. DR is the abbreviation for debit, and CR is the abbreviation for credit. You will see it written like that for the rest of your business career. Okay, debit is DR. It's not always capitalized. Sometimes it's capital D, small r, capital C, small r. And when you write out a transaction, this is usually how it's written out. You have debit first, and then an account name and a number, and then credit is the line below it, and it's indented a little, so credit is a little bit to this side, and then you'll have the account name and the number, okay? And all of that stuff you guys will pick up as you go. I just want to introduce it right now. So let's pick a transaction out here that we already talked about. So when we talked about, question, yeah. Every single transaction will have an equal number of debits and credits. That's the second component of balance. Okay? If you find yourself writing out a transaction and the debits and the credits do not balance with each other, you did it wrong. There's no exception to that rule. Debits and credits will always equal each other. Okay? And I don't want you to worry about, oh, I need to know which account is a debit account, which account is a credit account. Where to put which accounts is not what we're worried about right now. Okay? All I want you to understand right now is this idea, this concept of balance. Okay? So an example of that would be Walmart paying salaries. Whoops. Let me put this over here. Hold on. Okay. If Walmart was to go and pay $10,000 worth of salaries, okay, this would be, and let me erase this out so I can write it in here. Okay. Notice here two things that are important. One, my debit and my credit are equal, right? They balance with each other. I have a $10,000 credit to cash here, a $10,000 debit to salaries expense here. So if I was keeping track of that on my T-chart, the debit to salaries expense tells me which side of the T-chart that needs to go on. So that needs to go on the left side of the T-chart for salaries expense. Remember, the T-chart is just how you keep track of an individual account. So in this transaction, we have two accounts that are affected here. Don't worry that you don't know why there's a salaries expense account yet. Okay? Cash is one you should understand intuitively, right? You know if you have a certain amount of cash. Okay? And we'll keep track of that in the cash account. So for this transaction where I paid $10,000 to salaries of employees for Walmart, I would have a $10,000 entry on the left side of salaries expense because that's a debit. And if I were to go to my cash account, I would have a $10,000 credit for marking on the right side of the cash account. Okay. Why does it go on the right side and the left side here? Just because my simple definition of debits and credits was anything that's a debit, when I write that in a T-chart, it goes on the left side, and anything that's a credit goes on the right side. Yes?
So you have to have an equal amount of debits and credits, right?
Yes.
But not in the same account necessarily?
Right. And almost never will it be in the same account.
Just like at the end
Because,
of the day?
yeah. Okay, so remember what I was talking about with, like, if I took $10,000 cash out and just went back right around and deposited that same $10,000? That wouldn't make any sense business-wise, right? So pretty much always, if there's a business purpose to what you're doing, it's probably going to involve more than one account, okay? And it doesn't necessarily have to only involve two accounts, right? Let's say that my employees really like hot dog buns, okay? And they've agreed to be paid $5,000 cash, $5,000 in hot dog buns. So that would probably be under an inventory account. Again, don't worry about the names of these accounts. Okay, so I could have a transaction that looked like this. And then I would have a third account T-chart up there that would be my inventory account. And this credit would tell me that I would want to put a $5,000 on the right side of the hot dog bun T-chart account. Okay, and this could be, I could have 30 different accounts on this side. As long as for each individual, this is just one transaction or one journal entry. For each one of these, my debits and my credits must balance. Okay, that's the main takeaway from this discussion. They must balance. Okay, we will get into all the ins and outs of what type of account this is, why it's named that. All of the intricacies of that will come out as we go through these chapters. Yes?
You say that it must balance.
Must.
If it doesn't balance, does that mean that the business is in trouble or that you did math?
You did math wrong. Okay? On the reverse of that is also true. Just because it balances doesn't mean it's good for your business, right? So even businesses that are just hemorrhaging money and losing money left and right day by day, still, as you record those losses, it will follow these rules. Debits and credits will always balance. Also, that basic accounting equation will always be equal on both sides, okay, no matter what. That doesn't mean that you can't have negative numbers, right? So even if that equation balances because you have negative 500,000 or negative 500 million in assets, obviously that's not good, but the rules still apply, okay? Balance on both sides. Okay, so main takeaways from today. That's all the new material I want to go over. Main takeaways. What is the basic accounting equation? So you should have that down. We will go over and practice components of that as we go on. The fact that the basic accounting equation must always balance. So any transaction that you do will always keep that equation in balance. Debit means left side of the T-chart. Credit means right side of the T-chart. And debits and credits for every individual transaction must balance. Those are the takeaways from today. Any questions on any of those takeaways? Okay, I will post this lecture up again on Blackboard. If you have any questions, let me know. Final thing for today, this Friday, you will have a quiz on this material, but since it's just the opening quiz, the quiz will be over what's on the syllabus and what we've gone over today, the main 4 takeaways. Since it's going to be simple and everyone should get 100% on it, it's going to be due on your own exam or quiz. There's no class on Friday. Okay, so you will just take it, you'll go into Blackboard, click on week 1 under assignments, and click on the thing that says quiz. It will pop up on Friday. Okay, so sometime between 8 in the morning and midnight on Friday is when you'll have to take that quiz. on your own time. Any questions about that? Okay, see you all next week.